a quick lesson developed to explain the variable overhead variance and the fixed overhead variance. Remember that flexible budgets are geared towards all levels of activity within a relevant range for an organization. So when we compare or calculate variances for variable overhead, you have to keep that in mind when you're comparing the actual to the budget. It's the flexible budget that we want to compare it to. So just a quick chart that I used to keep the variable variances straight. Okay, this is the chart that I use. If you compare the actual quantity times the actual rate to the flexible budget for the actual level of activity times the standard rate, so this would be the flexible budget for the actual level of activity. And then you would take that and multiply it by the standard rate. Now this comparison would give you the total variable variance, or the total variance for the variable overhead. Now we need to break that down a little further and see why that there is a variance, and there could be a spending variance. And you can calculate the spending variance when you take the actual quantity and multiply by the standard rate and compare it to the actual quantity times the actual rate. Then you can calculate an efficiency variance. And the efficiency variance is calculated by taking that flexible budget and comparing it to the actual quantity times the actual rate. Now we also have fixed overhead variances, and the fixed overhead variance is calculated by taking the actual fixed costs and comparing it to the fixed costs applied to the work in progress account. Now we know that fixed overhead is applied based on a predetermined overhead. Now we know that overhead is applied based on a predetermined overhead rate. So what we're going to do is take the, to get the actual applied overhead for the fixed costs, we're going to take the actual quantity and multiply it by that predetermined overhead rate. And that's going to give us our total fixed variances, or fixed overhead variance. Now this variance can be broken down into two pieces as well. We have a budget variance. So maybe our budget was set too low. And to calculate that one, we need to take the actual fixed costs and compare it to our budgeted fixed costs. And these are the numbers that we use to calculate the predetermined overhead rate. And we can also calculate the efficiency variance. That efficiency variance is also called a volume variance for fixed costs. And with the volume variance, it's not a measure of spending. It's only affected by the level of activity. When we calculate the volume variance, we're taking the budgeted fixed costs that we use to calculate the predetermined overhead rate, and then we compare it to the applied fixed costs. There's a way you can check your work if you're given the information in the question. And basically what happens is that these total variances, both the variable variance and the total for the fixed variance, can be added together. So we can take the total variable variance, and we can add or subtract, depending on whether it's favorable or unfavorable. We can add or subtract the total fixed variance, and that's going to equal your under or over applied overhead. So if you're given the information to calculate your under or over applied overhead, you can be able to check your work quite nicely. Remember that over or under applied overhead is calculated in your manufacturing overhead account, we have actual manufacturing overhead going into this account, and then we have applied manufacturing overhead coming out of this account. So the difference between those two will give you your over or under applied overhead.